Welcome, everyone. Today, we're going to continue our Connect Conversation series, where we talk to industry leaders about specific topics that are relevant to all of you. Today, we'll be talking about something that I actually hear a lot about in my conversations with our government members, and that's stable value products. So joining me for that topic is Mike Norman. Welcome, Mike.
Thanks,
Mike
Matt.
is the president of Galliard Capital, knows these things inside and out, so we'll get a little knowledge today about what's going on with stable value. To start, we did put out, hopefully those of you who are on the member distribution list saw that we put out some PRRL research looking at our database. So just as a reminder, we have about 3 million participants in our public sector retirement database. We did a deep dive on stable value to see if there were any patterns or trends that we thought were interesting. I think, when you looked at the data for age, it made sense. There was kind of this parabolic curve that went up as people got older, higher use of stable value products. There were some interesting numbers when it came to tenure, a little bit of a smile. Folks in their 60s, 50s, and 40s who early in their tenure maybe had higher allocations of stable value, and then it dipped a bit and then went back up. We didn't really have a good explanation for that, but Mike, I just want to get some thoughts and see if that's in line with what you're seeing among your clients, and if there's any thoughts that you have on where that might come from.
I mean, that's really good. And I agree. Looking at the smile charts is a little bit like we have to think through that a little bit. And a couple of thoughts though, as I pondered it after you're nice enough to send it over to take a look at. When I think about stable value, right, and let's broaden it out, not just governmental plans, but I look at corporate plans as well too, and stable value as a whole. When you kind of break down the full asset category, the factor that I saw recently was like 88% of stable value is owned by people over 50, right? So so I'm like, okay, that's good trivia for thinking about that smile piece. The other piece of it is then when you look at the pie, active versus inactive, right? Retirees versus active, it's roughly about half, 50-50, give or take. It's 48 active. So I was like, okay, how does that really make a difference? And I said, when I looked at some of your data, it made some sense because I've had a couple studies where we've seen that younger people are starting to invest in stable value more, which is a little counterintuitive. And they were going, and the thought process behind that is the 30s and 40-year-olds have kind of lived through nothing but economic downturn to a certain extent over the years. And so they're more concerned to be savers than they are for really growers. And so that's kind of why they've kind of been leaning a bit towards stable value. But when I looked at your numbers, and I'm like, wow, it was fascinating that where you had like the very short tenured people across all age categories higher in the initial years, that 0 to 2 year range, then there's a dip down, and then it went back up for an allocation. The only thing I could kind of come up with thinking about these overlays that I just mentioned is, in general, I think maybe people in their transition want to stay, they just want to get into the 457 plan, the 401 plan, and really just kind of have an extra allocation of stability before they kind of start allocating into more risk assets, and then they rotate back as we would expect them as they either become inactive or whatever later on in their tenure.
Yeah, that's an interesting thought and a plausible explanation for sure. We usually hear kind of the default, the default hypothesis, like how people are defaulted into it and then they have to pick something out. Obviously, that's not as strong of an effect in public plans because a lot of them don't have default, right? They're not auto-enrolled into it. And so there may be a smaller effect there. But I think that is an interesting hypothesis as you come into the plan. Maybe that you just kind of park your cash for a little while, figure out what you're going to do, and then move it around and then go back to stable value as you get older. It makes sense.
The second piece of it, though, is, it's good to see from a stable value practitioner standpoint, it's good to see that there is some consistency from, roughly 15 to 30% allocation, depending upon how you looked at your different graphs. And and we know that in governmental plans in particular, that allocation to stable value tends to be a lot higher than we see in corporate plans. And I think we realize why that is for a variety of reasons, but your data kind of backs some of that up, except for 403B plans, which are a whole nother ghost entirely.
Well, and to be clear on our data, we have a very small group of 403B plans, so we don't want to over-index too much on that. group. Then just the nature of 403B, there aren't as many in the database. So great points, great points. And it's a very complex, for a simple kind of a simple asset allocation piece, it can be a very complex structure. So do you mind kind of breaking that down a little bit? Maybe talk just a touch about what stable value does, and then some of the different ways that it can be structured to work inside of a portfolio.
Well, it's interesting when you say that, Matt, because when we are talking with prospects and clients, whatever, stable value is not all created equal, to your point. And there's a bunch of different ways to access stable value, and it depends on the plan. Like we just talked about, 403B plans are going to be different than you see the 457 or the 401 plans. And so, as you look across kind of the global stable value market, let's call it, it's about $882 billion monster, right? When you really plug it out. And I was looking at some data from our industry association, your counterparts over at SVIA. And the data that we got out of that is when you kind of look at like plans where you have either a single insurer, there's one way to break it down, or like an insurance company is the only provider of that kind of insurance to the plan. That's what we think of as single insurers. And then you have multi-insurers where for folks like us and other investment managers, where you're going to have multiple different issuers underneath the hood to broaden out that diversification a bit. That's actually, interestingly enough, about a 50-50 break as well. So when you look at plans, and we see this in the governmental space for sure, there's some single insurer what's general account backed product, meaning you're standing in line with the other creditors at the insurance company. They think of it as just a creditor in case there was ever an issue, but it gives you a little bit more bandwidth as far as some investments go typically, right? Because you can invest in the insurance company general account. Or then you move over into another kind of single insured product called a separate account. Separate account and insurance separate accounts we're seeing out there a little bit more and more coming back into the limelight a little bit, and that has segregated assets, allowing the particular plan to have their assets in a separate bunch from all the other general creditors, which is good kind of protection feature. But that's still a single insurer to one insurance company or bank that's issuing that. And then finally, you have the multi-insurers like we do at Galliard and other peers of mine do as well, where you have multiple insurance contracts underneath the hoods. And then you have a bond portfolio that sits underneath. That's called the wrapper. A lot of times you hear that. It's like a synthetic GIC is another name for it, all the same thing. But interestingly enough, that when you put those kind of two blends together are again kind of 48 to 52 break for the overall asset with single insurer to multi-insurer. The other interesting piece about that, though, when you break down that single insurer part, the majority of it is with 403B plans. And that is just purely because of the fact of kind of the regs and what they're able to invest in right now with it. So the good news is, I think what you really see as you kind of look through it is most of the plans that we see in today's governmental world are these multiple insurer wrap contract underlying bond portfolio plans, because it allows the plans to participate in the underlying investment performance. And that brings a little bit more performance back to the participants, which helps.
Okay. And I want to touch on a couple of things you said there. So some people may be kind of confused, especially if you don't oversee a 403B plan. Why couldn't they use any of these structures? So we've been advocating for quite a while for the inclusion of collective investment trusts and insurance separate accounts as an option for 403B plans, because currently public 403B plans are only allowed to invest in mutual funds and in annuities. And so they are actually quite limited in what they're able to do. And stable value is one of the spots where that shows up. So that is helpful to kind of understand how those different structures exist and what you're limited to if you're a 403B. Like your universe is a little bit smaller. And then just one other quick thing, you mentioned the stable value, SVIA, the Stable Value Investment Association. We'll put a link to some of their stuff if you all are interested in learning a lot more about stable value. Obviously, the Stable Value Association has some really good information, things like definitions, resources, research papers that can be helpful as you get into a deeper dive. It is very... when you start talking about synthetic GICs and those kind of things, it does get fairly complicated. So a lot to think about as you're building these different structures. So when you're talking talk me through a little bit those mechanisms and how like a plan sponsor can think about which of these are best for me. Like how, what are some of the kind of decision points that you might discuss if you had somebody that you were walking through this?
So the great news, Matt, when you think about it, is all stable value, whether we're talking single insurer or multiple insurers, pooled funds versus separate account, all the different terms that go floating around with that, all are thinking about the same thing, right? Stable value providers overall, you go into stable value with the primary objective of principal preservation.
Yeah.
And so, I think you start at that level, and then we can kind of peel it back from there as plan sponsors are thinking about, what kind of type or what are the pros and cons of the different ones. But in general, when you have these, as we think about now, just to level set everyone's expectations, right? Whether it's a single insurer product, whether it's a general account, or whether it's an insurance separate account, or whether it's a pooled fund or a separate account, you have some sort of asset pool underneath the hood, for lack of a better term, and then you overlay that with insurance or a book value contract issued by either an insurance company or a bank, and it's that contract that allows stable value to do what stable value does, right? And when you think of stable value, you think of day-to-day principal preservation. You think about your participants being able to come in and out of plans at book value, not market value. We'll talk about that in a second, but that's a really big piece of it, because when you look at stable value over time, what you're really looking for, right, are the returns comparable to kind of a short intermediate bond fund, kind of longer duration fund, but with the volatility that you'd expect for something really short, like a money market fund, for instance. So you want to have really low volatility. But to get that, you have to have these insurance contracts. And that kind of falls back into your question of, well, how come these contracts are functioning the way that they do? And it's important to, for me, at least I can kind of break it down into two pieces. And I think most plan sponsors that have stable value have thought about this a little bit, but I think it's worth thinking about. There are rules for individuals, plan participants in the funds, right? A few rules. We'll talk about those in a moment. And then there are some rules for the plan sponsors. And the rules are there in their contract terms. Rules, kind of a light phrase, sorry, but the contract terms are there to really help protect that pool of assets, so that if there are changes, whether it's by participants or plan sponsors, there's some protection that the people that stay in the fund long term don't get overly negatively impacted one way or another as it goes. So, one of the things that that I think about, let's talk first though about how do these plans work. So with this insurance contract right, what it does is there's a couple. I'm going to go deep on you here, Matt. So you got to run with me.
That's what these are for.
When you think about how the contracts work, there's a bunch of inputs into the overall crediting rate function. Crediting rate is what comes to the participants at the end of the day. And you think about that, it's the market value of the bond fund, it's the book value of the overall stable value fund, it's the duration of the portfolio, and it's the underlying yield to maturity. And you kind of put those together, and that helps calculate over time what that crediting rate is going to be out to participants. And so there's a bunch of ways, a bunch of factors that you can levers that you can move around on it. But the easiest way for me to think about it is you have book value, which is principal plus accrued interest, right? That's kind of that your par, let's call that 100. Then your market value is going to move depending upon the interest rate environment. It's either going to be above par or below par. And then, of course, when the rates are moving in your bond portfolio, so is the underlying yield of your portfolio. So the yield is a big piece of it. So you can have a big yield in your portfolio, but if the yield's up, that might mean that your market value is down, and you have to amortize those market value gains or losses back across over the life of the contract. So let me put that a little bit simpler. When you look at what these contracts are doing on a day-to-day basis, is they're amortizing the gains or losses in the portfolio over the duration of that portfolio, whatever that underlying bond duration is, and then factoring in the market return that's happening on the yield side. So you can have a good yield at say 5%, but if you have 3 points, let's say you're at a 97 market to book, you're amortizing a 3-point loss over your portfolio. So that 5% is going to be reduced by about 1% a year in order to converge market to book back to par. And that's just the mechanics that happen. Participants are oblivious to this. We'll talk a little bit later about some of the pieces there. but that's really the deep weeds of the situation, and it's going to come up as we've seen with these inverted yield curves and different things that have happened in the market space, and we can talk a little bit more about that later.
Yeah, absolutely. So let's talk about a little bit the difference between a participant level withdrawal and a plan sponsor level. So, if the plan's going to change, or if somebody needs to, take their money out, how are the contract provisions different in those cases? How do those differ to kind of protect, like you said, the overall fund?
So the easiest way to think about, Matt, is those provision terms are there to help manage liquidity in the portfolio, right? A lot of plan sponsors also are like, why do you have this stuff? But it's there to make sure that we have adequate liquidity without negatively impacting the portfolios. From a participant standpoint, really the only thing that you kind of have is a clause, or anything that you have to think twice about, is if you have a competing fund in a plan, say like a money market fund, and you can't go directly to that. Meaning, why can't you? Well, what the contracts are looking to protect against is, you do want to protect against what we call hot money, disintermediation risk, and having people chase it at the wrong time, impacting the portfolio by moving out of the portfolio when rates are spiking or whatever the case may be.
Mhm.
So that's at the participant level. So that's pretty simple. That's a 90-day equity wash is the term that most people think on that. The plan sponsor side gets a little bit more involved when you think about, what are things that plan sponsors can do that might force a bigger move of assets? So, for instance, a plan can't put out a marketing piece saying you should move out of stable value, right? So that's considered a plan sponsored withdrawal. One
Mhm.
thing that we might see coming down the road here to government entities, they haven't had it for a while since I've been doing this, is what happens if there's a plan event, meaning maybe there's layoffs at the governmental level or whatever the case is. If you're reducing your workforce substantially and we're going to see a bunch of people jump out of the plan, that may cause for a plan sponsor withdrawal that
Mhm.
you have to work through with your stable value manager. So a lot of different pieces of the puzzle there.
Yeah, it's a complex soup for sure. And one of the major components, as you mentioned, is the interest rate and the yield curve. We've been in some kind of strange times regarding the yield curve, a little bit of an inversion. The short-term rates have been higher occasionally than the long-term rates. Obviously, that impacts stable value. Bond prices, it changes. Obviously, that impacts stable value as well. So what are you looking at when you look forward? There's been a lot of change lately, but as you kind of look forward and how that market is working now and what you think, I'm not going to ask you to make any predictions on what the bond market is going to do, but as a stable value provider, how are you thinking about that in terms of the future of stable value and what it means for return streams?
So it's a multi-tiered answer. It's a really great question, by the way, Matt. Thank you for that. You think about what is stable value doing, and the short answer is stable value has been performing exactly how we expect it to do. You look back to 22, right? Stable value was the star, if everybody remembers back to 2022. Equities were way off, bonds were way off. They were correlated together. Everybody had totally negative returns. The only thing that was positive in the portfolio were stable value funds, typically, because of the way the book value contracts work, and that works fine. Post that point, we've had big rate changes and the whole thing that's happened since 22. But what you've really seen is the stable value portfolios are working as we intend them to do. Underneath the hood, you look at most of the yields underneath the hood, they're at high fours to low fives from a yield standpoint. But what the participants are seeing, and plans are looking at their reports saying, what do we get? It's probably in the called mid twos to mid threes, and that's because of the difference of that market to book. So partially, to long-winded answer, is these portfolios are really doing well. They have this underlying portfolio yield that's pretty competitive, that we'd expect for an intermediate duration bond portfolio. But what we're seeing, and a lot of people are looking at it saying, well, stable value funds are underperforming money market funds. And that is absolutely the case. And that's because of that inverted yield curve going backwards on the side. So what I think, to shorter answer to your question, is over time, we'll see that yield curve come back to approximate normal, right? Where you're going to have lower yields on the front end of the curve, meaning the short side money market type stuff. And it'll be long, you'll get more return the longer you go out on the duration spectrum. That will over time be then back to equilibrium for stable value, and you'll start seeing those 4.5%, 5%, assuming that kind of rates stay where they are, and you'll see everything else settle back in. So It's a dynamic that we're seeing kind of go down the path. We're not there yet because we're still amortizing those losses, and that's going to take some time down the road. But there's so many things that can factor into changing that. It could be one rate drop. It could be a whole change in the marketplace. It could be unsettlement across the board. Look at the consumer confidence that we've seen lately. That's all moving around. Moral of the story is it's more to come, and it's going to take some time, but there's a lot of factors and levers that go on to make it come back.
Yeah, I don't think anything's too certain right now, but it does make sense. There is that general trend back towards some normalcy for stable values. So I think there's a ton more we could cover. We can't do it all in this amount of time. I think you've covered a ton in a very short amount of time. I really appreciate you coming on and having this discussion. Hopefully it's been helpful to members. We're going to post some links and some resources along with this recording. So check those out as well. We really appreciate you coming on, Mike. Thanks again. And have a great day, everyone.